All right, welcome to Talk Tickers. Today we're going to dig into DSV's pretty pivotal third quarter earnings call. In a market that's just full of uncertainty right now, DSV came out with a quarter that really made investors sit up and pay attention. So, yeah, let's get right into it.
And look, the market's immediate reaction, it was pretty clear. The stock popped over 5.6% right after the call. So, what was it? What did investors see that they liked so much? Well, it turns out it's this really fascinating story about, looking past the big headlines and really drilling down into execution.
So let's look at the headline numbers, and really it's a story of beats and misses. At first glance, the quarter was kind of a mixed bag. It's one of those classic situations that could have sent the stock either way.
Okay, so this is where it gets really interesting. You've got this divergence, right? Revenue actually missed expectations. Not by a little, by a decent margin. But, and this is the big but, the number that really matters, the operating profit, or EBIT, it actually came in ahead of what everyone was expecting. And that's the key takeaway right there. In this kind of environment, the market is telling us it cares way more about profitability and keeping costs in check than it does about just growing the top line. And if you want proof of that, look no further than this number, a 96% cash conversion ratio. I mean, wow, that is just such a powerful signal of how healthy the operations are. It basically means they're incredibly good at turning their profits into cold, hard cash. And that's exactly what you want to see when things are tough out there. It gives them options, it gives them flexibility, and it helps them pay down their debt. Super important.
Okay, so that brings us to the real heart of the story here, the Schenker story. This is why investors really rewarded the quarter. Look, the market's optimism wasn't just about one good EBIT number. No, it was all about the massive, ongoing integration of that huge acquisition they made, Schenker.
And let me tell you, management is not messing around. They are moving fast. They have already cut the white-collar headcount by over 3,000 people. That's a huge number. This isn't some plan on a PowerPoint slide, right? This is aggressive, real-world cost-cutting, and it's happening right now. And get this, it's even happening ahead of schedule.
And because they're moving so fast, you can just feel their confidence growing. They've raised their synergy target for 2025 all the way up to 800 million Danish kroners. Now that's up from a range of 500 to 600 million. That's a big jump. This is basically management signaling to the market, hey, not only is our plan working, it's working better and faster than even we expected.
But that brings up the million-dollar question, right? Can you really cut costs that aggressively without just blowing up the business and scaring away customers? Well, if you listen to the CEO, the answer is a resounding yes. He made a point of saying on the call that feedback from customers has been really positive and, critically, they've seen very little attrition, that's customers leaving. And this is so important. It means they're pulling off this massive integration without losing the very people who pay the bills.
Okay, but it wasn't all sunshine and roses. We have to talk about the headwinds. Management was actually very upfront about the challenges they're facing, and they adjusted their outlook because of it.
So what they did was narrow their full-year EBIT guidance. They basically shaved a bit off the top end of the range. Now, usually any kind of guidance cut is seen as a negative, right? But what's interesting is that in this case, the market seemed to see it as just prudent, realistic, especially since they kept the low end of the range exactly where it was. It almost signals that they have a really solid handle on the business.
And they were super specific about why they did it. This wasn't because of some screw-up on their part. The guidance trim was all about external stuff they can't really control. So, what are these headwinds? Well, you've got a pretty big hit from foreign exchange, like 500 million kroner. Then you've got just softer global volumes in general. The usual geopolitical uncertainty we're all dealing with. And one little detail I found interesting, they mentioned smaller transaction sizes, which basically means they have to do more work to make the same amount of money.
All right, so let's get to our take on all this. It's time to synthesize the quarter and look ahead. So what's the picture? You've got a revenue miss, but an EBIT beat. You've got amazing cash generation, and you have this massive integration that's not only working, but it's accelerating and helping to fight off all those macro pressures. So that leads to the big question, right? Where do we go from here? For anyone looking at DSV, what's the big takeaway for the next quarter and even beyond that? For us, looking at all the evidence, the story here absolutely warrants an outperform rating. Plain and simple, this is a company that is proving it can execute its way through a really tough environment.
So let's break down that thesis. It's all about execution over uncertainty. First, that huge Schenker integration, it's becoming de-risked. The chances of something going horribly wrong are getting lower and lower. In fact, it's accelerating. Second, all that cash they're generating, it means they can pay down debt way faster than anyone expected. And that sets up a really powerful catalyst for 2026, when they can start returning capital to shareholders through buybacks. And really, at its core, this is a story about a management team that is just masterfully controlling everything within their power.
Okay, so that brings us to our plausible trade idea. This is where we look at a scenario that, it might seem a little bit out there at first, but it's totally grounded in the results we just saw.
So here it is. The position is simple. Long DSV. The catalyst you're watching for is an earlier than expected return to share buybacks. The market is penciling in 2026, but what if it happens in late 2025? And why would that happen? Because, like we said, that incredible cash flow is letting them pay down debt ahead of schedule. So the rationale here is that while the rest of the market is totally fixated on macro headwinds, freight volumes, tariffs, you name it, they're underappreciating the huge boost to EPS that's going to happen when DSV turns that cash fire hose back on to buying its own stock.
And of course, we have to end with this crucial reminder. This is not financial advice.